Morning, Chris.
Good morning, sir. How are you?
Good, good. This is Brian Jones. I'm here with Chris Hood, professional trader, world's most interesting man. And
The world's most painful knee today.
yeah, so what happened?
Oh man, it's called geogra- geriatric resurgence and overexuberance. I damaged my knee a little bit last night, so I'm hop along this morning. I'm trying to see if there's anyone walking past my house today with some walking sticks, and then I can borrow them. So I'm going to be standing up and I'm going to be squatting down just to take the pressure off my knee. So I think I'll be okay. I'm one of those resilient old guys. So we'll see what happens.
So you said you were applying a triangle and you heard your knee pop. So you're dealing with the little after effects of jiu-jitsu.
Yeah, yeah. It's almost like don't do moves that 18-year-olds can do pretty easily. Just constantly dial it back a little bit and make sure that you remember your age. But yeah, it sounded a lot worse than it actually is. It's a little swollen and blue today, but we'll see how it goes over the next couple of days. Should be all right.
Yeah, have you ever tried the CBD THC rubs, like the creams for anti-inflammatory stuff?
I tend to inhale them more than anything else.
But well, I mean, that works too. But the cream's actually really good.
Yeah, I've got a sort of annual supply of Voltaren gel in the back, so I put that on, and I've got a pressure bandage on at the moment just to keep it up. The problem is when I sit down and the knee bends, it sort of pulls and then it throbs and gets painful. So I've got to stand up, sit down, just to keep the blood flowing and do that. But I'll survive.
Move however you need to move, and we'll just get this going anyway.
So if you see me suddenly doing this all the time, it's not your camera.
So what about the market? It's pretty flat yesterday.
Oh yeah, so yesterday was a little bit dull. We've got Fed tomorrow. We've got CPI numbers that come out. So the market tends to hang around every word that gets said by these guys. I was reading this morning that a couple of them are already starting to put the tapering conversation in. With the Fed stopping its bond purchases and starting to pull out of the market, there will be an element of, there's no longer going to be this surplus coming into the market to push prices up. So, from a trading perspective, you're not going to change that. Yeah, I think that the discussion of tapering has been around for a long time anyway, so it's no surprise. They're not telling us stuff we don't know. But remember, the stock market is a forward-looking engine, and you have to take that into account when starting to trade. So I think on the very, very short term, there's going to be more volatility because, some of the longer funds are going to have to pull out of the market a little bit, maybe de-risk their portfolios a little bit, move a bit more to cash. I see huge opportunities though, because this kind of volatility starts to spike premiums, particularly in the put spread side. And we've had a really good run over the last 2 weeks in the Alpha Hunter product. I think last week alone, I think we banked 5 winners. So it's more a question of just reduce the time frame of your trades. Don't try and trade over these long extended periods. Even if you sell premium that goes out far, just look at your plan and make sure that you close the trades quickly. You can sell far premium, let the volatility or the trend push the price up, and then you cash out. So don't hold to expiry. I see a lot of beginners making that error where they sell a 42-day put spread and then try and hold it on excuse me, for 42 days, and that doesn't make much sense. So sorry,
I have a question about that. Does it change your profit target at all in your trading plan to trade let's say a same week expiry option versus a, say, 42-day option?
Yeah, you can alter it. I find excuse me, I've got half of the amphibian population of Ontario sitting at the back of my throat this morning. I think you can make it either way. If you become too dogmatic on profit percentage, the P&L percentage, you can miss the exit. So some people, they tend to hang on for dear life on put spreads, which in my view isn't the most effective way of managing them, because they are profit limiting strategies in the first place. So, excuse me, let me just have a drink. Ooh, someone just ran past and they were carrying a stick. I might have to
Dangerous.
go after them, see if I can borrow it. So if you've got a strategy like put spreads, for example, you can manage them on two ways. One of them that I prefer is this. I try and set a price target for the underlying. So if the price moves up to a Fibonacci extension, I will then go to my trades, see what the profit is, and then if it's within the realm of my plan, I will exit the trade. All right. So I use the profit methodology of the price of the underlying moving the option trade. If you go with the erosion theory, right? So if you're looking at, I'm going to hold this for 21 days, I'm going to let theta work for me, etc., 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 you can run the risk of getting to, say, 50% profit and then holding out for dear life, and suddenly the stock reverses on you and you turn a 50% winner into a minus 50% loser. So put spreads have some nuances. You've got to be really careful when you do credit spread trades about what your expectation is on the trade. In periods like this, I try and look at price movement of the underlying, push it to a price target, then check the position. If the position is at a profitable level, reasonable within your confines of plan, then exit the trade and just redo the trade. Don't hold on to a trade unnecessarily for an extra $50, $100 and risk $300 of profit. That doesn't make sense. So yeah, you can adjust it. Those nuances are very individualized, right? There's no such thing as saying, well, this is the only way that works. There are many, many ways to run it. It's really up to you as the trader, what makes you more comfortable. And I'll adjust it every now and then. For Google, for example, I'm very comfortable with Google's trend and Google's behavior. I will hold a Google spread, for a 20, 30% profit, and then I'll recycle it. I won't hold it for long, because those premiums are so juicy that the actual dollar value of profit that you make doing a Google put spread, even though I've sold them maybe in the money 90 days out, a small movement in price in the short term can actually affect that value really quickly. So you've just got to manage it according to your profit goals, right? So, trade to your P&L. If your goal is $1,000 a week, hit the $1,000. Like, that's what counts. It's not about, oh, I got 9 trades that were all 100% winners, but I never hit my goal. Like, that doesn't make sense to me at all.
So you'll scrape off, if you need extra money that week, you can scrape off some of the put spreads. Yeah. Not metric.
My goal, my annual plan is very, very driven by individual activities that are monthly, weekly, and daily. So if I hit my daily goal, my weekly goal gets taken care of. If I hit my weekly goal, my monthly goal gets taken care of. So if I hit my monthly goal, my annual goal gets taken care of. The most important thing is remembering that your trading plan is 52 weeks, right? And if I have 1 or 2 weeks that don't look too good, that's okay. At the end of the year, it's going to sort of make up at the end. So, you don't want to be one of those traders that's so dogmatic that you land up being so rule driven that you can't make money. The thing is, in trading, it's as simple or as hard as you want to make it. And what I found for me personally with my style of trading is I have to achieve my goal on a daily basis. So if I can hit my goal on a daily basis, I'll hit my annual goal, and it gives me something to aim for every day. So it's a psychological trick that I've played on myself because I know how I act. And as you become more aware of your trading style, you'll find the way to get you to be consistent in those things.
So do you know traders that look at it more on a monthly basis as opposed to?
Yeah. I've got some clients that do that. They don't care about the daily. They only care about the monthly. So they'll sell. They might do a put spread that's got a 2-month or 3-month expiration and trade that way. They're more than comfortable to do that. And that works for some people. When you've got monthly bills to pay, you've got to hit your goal on a weekly basis in order to do that. If you've got no monthly bills to pay and this is a hobby and it's just there to, fund other kinds of activities, then doing a monthly goal without looking at the weekly is also fine. The thing that I find with a lot of the advertising and what you see on the internet is that everyone's trying to claim that they're the holy grail of trading, and there is no such thing. And a lot of innocent people get sucked up into the whole marketing spiel of this is the only way to trade. You know, like, I just don't buy that. I think the only way to trade is the one that works. I mean, I've been trading for many years, and it took me years to work out a system that worked for me. Now, whether my system works for someone else, you know, I don't know. You know, do we have the same kind of emotional makeup? Do we both react the same way? You know, when there's red on the screen and green on the screen, that determines a lot. So there's no such thing as the Holy Grail. There's no secret sauce to things, right? It's basically work yourself out, and then you'll find the trading plan that will work for you. Everyone on the internet is selling strategies. Strategies are easy. It's like tools. If you know that there's 25 tools that you need to build a house, you go out and you get those tools, right? But being a master at using them, you know, is completely different. That requires practice and patience. So, you know, a lot of times I see on the internet guys saying, oh, you just have to do this every day. But it took them maybe 10 years of practice to get to that point of doing it for 5 minutes a day. It's going to take someone who's never done this before, maybe, you know, a couple hours. So their expectation starts getting all mixed up, and that's where problems start to come about. So, you know, as you start building your trading career, rather work slowly and more, you know, in a more concerted way to work out what works for you. Just because it works for someone else doesn't mean it's going to work for you. I tried that many years ago. I tried to copy, you know, the trading style of others, that it just didn't fit my makeup. It just didn't resonate with me at all. I wasn't successful, yet they were. I was doing what they said. It's the same thing when you've got, you know, all these books that you buy on option trading. You know, you do exactly what the book says, and yet you're not making any money. And it's like, what the hell, man? You know, I'm doing everything that you said. I've got a whole cupboard full of these books. And the problem is that the market's dynamic, and the books are written in a static way. The information in a book is not changing as the market's changing. So you're applying a rear view mirror approach to something that's in front of you. Eventually you're going to hit a tree if you drive a car like that. So as you start doing the paper trading, I encourage my clients to do a lot of paper trading. Practice how a trade works, because when it's for real and you've got the emotional thing around real money and it's red and green and profit and loss and all of that stuff, your emotional makeup is going to cause you to do something. You have this sort of instinctive reaction to loss. You know, it's really weird when you watch new traders suddenly see their position go down minus $300 and they go, I've lost $300. And I try and teach it, no, you haven't lost anything until you exit. You know, while it's still there and it's going up and down, you've lost nothing. You're still in on the game.
It's an unrealized loss.
Yeah. Absolutely. And a lot of people look at their performance and they measure themselves on unrealized positions, and that's wrong too. You should only look at your realized P&L, and that determines how good you are as a trader. So, you know, at the end of the day, everyone has to make their own decisions on what works for them. And that's the type of approach I take with my clients as well. You know, your trade plan will be unique to you. No, I've never seen clients have, you know, two separate clients have exactly the same trade plan. You know, even if they, you know, live together, I don't know, they always react a little differently. So you have to appreciate that. And I think this is where a lot of the internet gurus and everyone sort of gets it wrong, is that they're not looking at the individual makeup of their client to determine what works for them. That's what counts. You know, I can send a trade to someone and say, hey, do this. And, you know, if I've got 10 people, I can get 8 people to do it right and 2 people will screw it up, but yet they both have the same information. You know, is that the trade that goes wrong, or is it the individual trader that manages the trade wrong? And that's really where it has to come down to. So it's how you manage things. It's not how you know, you can't, I always believe that you can't just copy a trade to win. You know, it's how you manage the trade that counts. So if you know where your exit point is, where your profit point is going to be, you know, what your expectation is going to be for the stock, then when you look at your position, you can always go back and say, well, did the did the stock do what I was expecting it to do or not? And if it didn't do what it was expected to do, you exit the position. It's pretty simple. But if you don't know that and you don't define it up front, the stock can do anything you like and you won't know. That's really where it comes down to.
Yeah, no, I like that approach. And I think that, with the Alpha Hunters program, they've got access to a webinar, every Monday morning to talk through and ask questions and learn how to do this. I'll learn how to manage it. Obviously if people want to just get trades, they can just get trades. But people want to learn, which you should, they should be watching webinars and using all the resources they have.
Absolutely. I think most people look at, the internet, there's a lot of stuff out there, a lot of stuff. And if you've got no background or no history in this, you can get suckered into a lot of stuff. And what I suggest to people is always test drive stuff. You test drive stuff to see if it resonates with you. If a process of identifying a stock, for example, is very logical, rather than, you go to Wall Street Bets and you see what the latest chat is all about, right? You don't want to be the bag holder and things like that. That's not cool. If your process is very logical, and most people are, when it comes to trading, most people are logical. If this, then that. If this, then that. They have to be. Yet, a lot of beginners don't learn the logic. What they have is they have emotion. So they trade on a feeling. If you say to someone, why did you exit that position for a loss? They go, oh, I felt it was going to. No. There's no such thing as feeling in trading. You can't have a feeling. There's nothing there. It's data. Everything should be driven by a data approach. And that's how we try and focus on in Alpha Hunters, is try and make sure that data becomes the core of what we trade and how we trade, rather than, here's the latest meme stock, let's go and run off after that. Because at some point, someone's going to hold the bag. And I don't want to be that guy. There's still someone out there that bought GME for $482.
I have a question. So pretty much all professional athletes, people that are really, really good at something or they've worked at it for a long time, are superstitious as hell. Are traders in general superstitious, do you think?
I don't know. I don't know. I love that thinking. It's like the way that I have my superstitions is it's setups, right? So if a setup looks the same all the time, I will trade it 99.9% of the time. If I see something that's the same as what I've made money before, I will trade it. I don't care about the stock code. I don't care about anything. I will trade the setup.
I'm just saying, do you have magic socks or something like that?
No, I don't have that. No.
I win. I'm a winner when I wear these magic socks. I have this for breakfast because it I always have a good day.
I don't know. I think I've never really thought of it like that. I have a very specific routine. So I do the same things every single day. Whether that generates my profit or not, I don't know.
I was just if there were any of those odd things in there. If you go through your charts and you do all this stuff, that's normal routine. I'm just thinking, do you have any of those weird quirks, that the pro athletes use when they go and they're like, it's game time. I can't wash my, I got to wear the,
no.
I got to wear the old underwear. This is the underwear that I won the championship with. I haven't washed it since then.
I tell you what I'll do. I'll start tracking my lucky underwear. So I'll start tracking which underwear I wear on what days I make money. And I'll come back to you in a couple of months and say, you know what? That pair of undies that I got from that shop down there, those tend to give me the best profits. I don't know. I could think of nothing worse. I don't know. I think there are some traders that will be, I suppose you've got to draw the distinction between routine and habits versus superstition.
Right.
Routine and habits, absolutely. I'm a very, very habitual person. I do the same analysis every single day. Every day at the end of the day, I do the same thing. And you've seen it. It's the daily video together with the file. It's the same thing. And I've been doing it that way for years.
Yeah, I was just curious. I didn't know if you had talked to anyone who's.
I will track my underpants from now on, Brian.
Who's like they. I don't need to know. I don't need to know about your underwear. So, but I'm just, if you have a magic hat or something that you wear when you're trading, your special.
No, but Brian, I tell you what, if I develop a magic thong, I'll tell you.
I really appreciate it.
No pictures. There'll be no pictures, but
Right.
I'll tell you.
Let me know,
I'll tell you.
because I'm gonna go get that thought.
I think that at the end of the day, the one way to generate consistency is to have a very stable emotional makeup when it comes to your trading. And there's only two ways you can do that. The first way is to accept 100% loss before you do a trade. So if you accept 100% loss before you do a trade, the immediate reaction is you're not going to oversize that trade. So that's one way to control the risk element, is accept 100%, size it small. So if I'm going into a trade and it's 10 grand, all right, and I don't want to lose, 5%. I don't want to lose, a 5% on that. I'm going to be watching that tick. And as soon as it hits that 5%, I'm out. I'm not even looking at the signals. I'm not looking at anything. I might take that loss unnecessarily. If I took the same trade and I said, you know what, I accept 100% loss on this trade, I'm going to do it for $1,000. I don't mind if I lose $1,000. I've got upside, etc., etc. My emotional reaction now to that stock moving is going to be completely different, but I'm doing the same trade. So you've got to get to that point. If you get to a point where you accept 100% on every single trade, or 100% loss on every single trade, you're going to have a trading portfolio that's very, very small. Very, very small. But you're going to be a far calmer trader. And I think that your win rates are actually going to be a lot bigger if you trade that way than if you just, dump 10 grand on a stock and then worry about the 5%. That's the kind of stuff that you've got to try and manage yourself. And the only way to get that done is through paper trading, because the paper trading doesn't generate the same emotional connection to a trade, but it gives you an idea of what to expect when trades go wrong. A lot of people think in trading that you can just wake up one morning and be profitable. It's so stupid. I mean, we do Brazilian Jiu-Jitsu. Could you imagine a white belt walking into your school and after the first lesson saying he wants to go to the World Championships? It's like, dude, you're gonna have to.
I can't actually imagine that.
I don't know where you live, Brian, but it doesn't happen up here in Canada.
I've had people come in and try to learn some jujitsu for their MMA fights, and I was like, well, when's your fight? And he's like, next weekend. I was like, I don't know what I can do for you, man. Best option is to not get hurt right now.
Yeah. Oh, that's nuts. I think with the with trading, a lot of people forego the practice element. They immediately just want to go and compete, and that to me is dangerous. I think you've got to land up practicing. You've got to know your shots. You've got to know the ones that win. You've got to know how to make them winners, and that doesn't come by losing a lot of money. I really don't believe that you have to blow out your account in order to be a good trader. I really don't believe that. I think you've got to try and manage yourself to avoid that. So don't trade to a point where you're going to blow your account out. The amount of stupidity that I see with novice traders focusing on one strategy only, they're completely ignorant in terms of market conditions. They keep doing it. And remember, the one thing I said a couple of weeks ago, I said, the market will reward bad behavior. So even if you've got that thing and it's winning, it doesn't mean it's going to win all the time. And when it doesn't win, you might give back all the money you've already made. So you've got to have multiple tools, multiple strategies that allow you to win under multiple conditions. And that's the skill. That's the skill set. So
I found an interesting article. It was some psychological journal about, with the rise in retail trading and how it relates, a lot of the same qualities. You've got a lot more people trading, and there's the compulsive gambler aspect to it. So they were looking at the mindset of the compulsive gambler and how people just start trading without any information or anything like that, and they're okay with it. Obviously they're losing money, probably winning some, losing some, but still they're just in there, and they're not analyzing anything. It's just
a lot of those people trade on dopamine addictions. It's all dopamine. So they get a rush out of doing something. So for them, placing an order gives them this sort of, this rush of dopamine. I don't trade like that at all. I try and teach my clients that you have to look at trading like a proper business. You can't go to any form of forms that you're filling out. They say, what's your occupation? You can't put gambler. Like people will look at you like, oh, that's a little bit dodgy. And trading, even when I talk to people and I go, so what do you do for a living? And they go, oh no, I'm a trader. I go, okay, cool. Talk to me about what you do in your trading. And there's some people that don't even use moving averages. They have no idea how those work. They have no indicators. They have no signals. They go, oh no, I'm in a chat group and I just take the trades coming from this guy. I'm like, okay, I'll talk to him in a year and see what happens. And the thing is, the media doesn't do a good job in detailing the risks. The thing is, they create this anxiety of FOMO. So when the media starts saying, oh, look at this guy, Johnny over here put $5,000 into AMC and now he has $1 million and he did this. And what that does is it turns everyone who didn't do that into, well, if Johnny can do it and Johnny's got a negative IQ, well, then I can do it, and then they go off and do it. And what they don't realize is Johnny got his Tesla or whatever it is from selling to people like you. That's the problem. But
Right.
no one wants to talk about that. That's the challenge. So
Yeah, it's definitely something that it takes a while and takes the skill. I mean, I know some people are probably really good at it from the get-go, but I wasn't one of those people.
well, the thing is,
But
a lot of people, regardless, come in with preconceived ideas on how good they are. It's an ego, right? You see it in jiu-jitsu. People walk in and they go, oh, well, I was a Division I wrestler, and I should be able to do this. So their self-expectation is so high that any degree of failure is just going to kill their ego, right? So they try too hard to maintain that level of perfection or whatever it is, and that can create problems in trading as well. So I say to people, you're not a good trader until you've done 10 years. If you can do this for 10 years, you're a good trader because you've managed to survive many, many cycles. But 3 months, one good trade, it doesn't make you a trader. It makes you lucky. The thing is, you have to try and trade away from luck. Sure, there's an element of luck that will always be in this game, but you can't rely on it. It's not something that will give you an edge. Your edge as a trader is your way of interpreting things. It's your way of connecting the dots. So you might find some traders that connect dots in ways you can't connect dots. They think of things you haven't thought about. And that's just practice and experience. You walk off the street and all you have is a lot of money. There's a joke. How do you make a billionaire in trading? You start off with, how do you make a millionaire in trading? You start off with $1 billion. It's like, because that's what happens. It's a reality that most people don't want to talk about. The amount of times I've seen people blow out their accounts because they do stupid things is so common. And yet you can warn people, you can tell them they're doing the wrong thing, their ego will get the better of them, and then they screw it up.
Sometimes you need to lose money, like real money, to actually just figure out that they need to buckle down and start to do things properly.
Yeah. Well, I think so. I think people need to understand their limitations, and that's where designing a plan comes into play. If you've got a plan that says, I will do this, this, and this, and then you suddenly start doing something else, you know exactly what happens when it goes wrong. You know that it was because you didn't follow the rules in the first place. So, you have to try and work out as you trade what's working and what's not working. And if something's not working, or if a trade goes wrong, it doesn't go wrong because the market conspired against you. You can always tell the difference between a trader who's mature and a trader who's not. It's when you ask them what happened to a trade, if they turn to you and say, the market went against me, that's the first sign that I look for, is how do they tolerate loss? Is it someone else's fault, or is it their own? All right. When you lose money as a trader, there is no one's fault but you, nothing else. The market cannot be blamed for something where the market doesn't even know you exist. All right. So you can't apportion blame there. It's always based on you and what your plan is. So if you've gone into a trade, regardless of, the market condition was X, and you misinterpret that, and you stay in a trade and you lose, it's not the market's fault. It's your inability to translate the information that was available. Did you know there was information? No, there's the problem. Now you need to add that into your analysis. If it was, yes, I saw that information and I decided to do something else, still wasn't the market's fault. It was your inability to connect the dot. And you misinterpreted the information. Therefore, you need to change your interpretation. When you trade, you have to get down to that level of granularity. Because when you've got a winning trade, it won because of something. It didn't win because you were lucky. When you structure a trade and there's all the conditions have been met and the trade works, the trade worked because of the conditions that were there. It wasn't because you were lucky or because you didn't. You okay? I can give you a virtual slap on the back if you want.
You can't inhale water.
And that's where people sometimes can't journal. They don't know how to journal properly. They don't really know how to look at their trades and go, well, why did this work as opposed to something else? And that's a skill that takes time. Because when you look at a trade, I know based on my back testing of various setups that if I do a trade that looks like A, B, C, and I do this religiously, it's going to have an 82% win rate. I can back test it. So why would I change that? If I know that in history has got such a high win rate, why would I look for something else? I just sit by, put my hands under my butt, and I wait for that setup to appear. And when it appears, I act.
So I have a question. So what was your biggest psychological hurdle to get over to start becoming profitable? Like,
I had to stop blaming everyone else but me. That was the big thing. When I was trading initially and I was reading all the books and I was doing all of the stuff that the books told me to do, my initial reaction when I lost on a trade was, but I did everything the book said. The book must be wrong. No, it wasn't the book's fault. The book was taken at a point in time. And at that point in time, that was correct. I can't take historical data, apply it to today under a different market condition. It's like this. If you look at Warren Buffett, for example, Warren Buffett, very, very wealthy in his trading strategy, but it took like 50 years to do it, right? You take the same strategy and you expect the same result over 6 months, you're not going to get the same result. It's going to be completely different. There are a couple of factors. One of them is Warren Buffett had time on his side when he started. So if you're 45 years old and you're going to do a 50-year strategy, be prepared to wait till you're 95. Okay, so that's the first thing. Number two, when Warren Buffett started his strategy, the market condition was completely different. Stocks weren't overvalued like they are today. We didn't have trillions and trillions of dollars being propped into the market by the Federal Reserve. We didn't have any of that stuff. Okay, so the market condition is different. So if you take a strategy that worked under X condition and assume it's going to work with the same result under Y condition, is it the strategy's fault or is it you? Like that's, to me, that's a little bit of, no, that's just stupid, because you should actually be looking at the market condition and saying, under these conditions, what would work? As opposed to, well, this worked over there last week, so it must work here. It worked on Mondays. It only works on Mondays, but today's Wednesday, so it must work. You can't do that. And I think getting over the fact that at the end of the day, I am singularly responsible for the P&L of my account, not the books, not someone else sending me a text message or whatever. I am responsible. And it's a huge jump for a lot of people, because a lot of people don't want to admit their failures. They don't want to sit back and say, oh, you know what, I screwed up. And as a trader, the first thing you've got to be able to do is accept accountability. And for years, I didn't do it. I mean, it's just normal. None of us want to do that. We don't want to go have a conversation with our spouse or whatever and say, hey, you know what, I'm actually quite an idiot. Like no one wants to have that conversation. And I think that single-handedly changed the way I approach trading.
So have you read the book, The Extreme Ownership by
no, but it sounds interesting.
What is it?
Sounds interesting.
It's Jocko Willink.
Oh yeah. Okay.
It's about taking responsibility. He's like, everything that happens is your fault.
Yeah.
Like everything, and it kind of has the same. It kind of hits at that, so it might be a good. I think it's kind of interesting.
I get it.
Yeah, it's a really
consequence in trading. Consequence trumps everything. You have to accept the consequences of even starting to do it. When I hear of these stories of, 18-year-olds mortgaging their parents' houses and going and buying, GME or whatever it is, and doing those stupid things, those stories, those extreme horror stories. I have no sympathy. I have zero sympathy. I don't feel sorry for these people at all, because what drove them to do it was extreme greed. There was nothing, when people are motivated to go in and make money without process, it's greed that drives it. It's not a structure that says, you know what, I want to change my life. I want to add something valuable to my life. I want to put a life skill in here that I can possibly teach my child. I want to make this a proper business. None of that motivates them at all. It's the motivation for them is being able to put a post onto Wall Street Bets and tell people how clever they are and how rich they are. That's not going to make you a good trader at all.
So basically you're saying that you've got no sympathy for my homeless parents.
So I know you. So yeah, I have a little bit of sympathy.
I'm just kidding. I didn't mortgage their house. They have a home.
I think maybe it comes out a bit harsh. I feel if your motivation to trade is purely greed, is a greed-centric strategy, you won't win. You might win in the short run in terms of, some little victories, but easy come, easy go. And, many people, it's like winning the lottery. When you hear people won the lottery and then 6 months later, they don't have any of the winnings, they've given it all away. It's the same thing in trading. The problem in trading, making money easy, holding on to it's hard. That's the problem.
When I first started, I was oversizing everything, got wrecked a little bit. And then now I'm more conservative, but I'm still building my way up to, being confident. Like I like cash in my account.
Cash is the position.
It's a good position to have. So I try to play with just enough to make my goals.
Well, you know how we trade, right? So we only use between 20 and 30% of our capital because we believe that like cash mitigates a lot of volatility. It gives you the ability to sleep at night. It helps you. It doesn't restrain you from going up. All right, you can still build your account really well if you've got a high cash balance. It's about being clever in how you trade. But greed is not the reason why you should trade. If you want to be greedy, go gamble. Rather just go to the casino, because at least they're black and red. It's a little easier, right? Pick a color. In trading, it requires, if you want to build a sustainable trading business for yourself that can provide you with consistency, it requires a mental shift. And for me, it was always about accepting accountability. That's the first thing. You're never going to be a good trader unless you accept complete accountability for you're the guy that hit the keys. When you miss out on a trade, you were the guy that didn't hit the key. When you didn't make money, you were the guy that didn't hit the key. That's it. You can't blame someone else. That's the thing.
Very true. Well, Chris, we just got a couple minutes before the bell, so we'll I really hope your knee gets feeling better. It's
me too, man.
You're like
I'm hobbling a little, man. I feel, what? I'll be okay. Give me a walking stick and I'll act my age. I'll be okay.
Get a brace and Voltaren.
Oh yeah, I'm going to ask them for a sponsorship. I think that's the key. It's good to see you, my friend. We'll see you next Tuesday.
All right, take care, Chris.
Take care, guys. Bye.